Isaac Newton lost £20,000 in the stock market. He invented calculus. If the smartest man alive couldn't beat the market, so why do you think you will? Here's the thing, more than you think. Because Newton's problem wasn't intelligence, it was psychology. And traders have been making exactly that mistake for 4,000 years. Different instruments, different markets, different tools. Same flaw. Today we're going back through history, era by era, to find out what your life would actually look like if you were a trader in each century. The edge, the risk, the lifestyle, the crash that ended it. Era 1, Mesopotamia/Babylon. 2000 BC. The ancient world. You're a merchant trader in Babylon. Your exchange is a sun-baked clay courtyard. You trade grain, wool, copper, and tin. Your prices aren't on a screen, they're scratched into clay tablets. Your contracts are wedge-shaped marks, pressed into wet clay with a stylus. If there's a dispute, you don't call a lawyer, you call the scribe, and if the scribe is wrong, you lose, because the clay already dried. If you're good at this, you're one of the Tamkarum, the merchant class, technically below the priests and nobles. Practically, you're the one with the money. You live in a mud brick house with a central courtyard near the market quarter. Scribes handle your records. Apprentices move cargo along the river routes. Your currency is weighed silver. Every transaction starts with a scale. Edge. Information. You know which caravan just arrived from Anatolia with copper. The guy on the other side of the courtyard doesn't. That gap is your profit. Risk. The king sets price ceilings on grain during famines. Your entire margin can disappear overnight by royal decree. You have no recourse. None. He doesn't need a reason. The king is the risk manager, and you're not the king. You wear a simple linen kilt and sandals. The wealth is in your storeroom, not on your body. Era 2, Venice, Italy, 1300 AD. The medieval merchant. You are a member of the merchant nobility, the patrician class that turned a lagoon into the trading capital of the world. You trade spices, silk, and glass. Pepper is worth its weight in silver. One shipment can make you rich. One storm can erase your entire bloodline. You fund voyages called commenda, a silent partnership. You back the ship. The captain takes the risk at sea. You split the profit on return. The captain drowns. The debt doesn't. If the ship sinks, you absorb the loss. And the next captain is already knocking on your door asking for funding. It's the world's first venture capital model. You are the investor. The ocean is the market. You live in a palazzo on the Grand Canal. Ground floor, warehouse. Upper floors, your life. You wear deep-dyed wool and velvet. Crimson fabric cost more per yard than most people earned in a month. Edge. Your network. Agents in Alexandria, Beirut, Constantinople. They send you market price letters. You know what pepper costs in Cairo before your competitor does. That lag time is your entire business. Risk. A single storm sinks your ship and your entire capital goes with it. Diversification means funding 10 voyages at once and praying 9 return. One bad season and the palazzo goes next. Era 3, Amsterdam, Netherlands, 1637. The first stock market. This is the Amsterdam Stock Exchange, the world's first. And you are trading shares of the Dutch East India Company, the first publicly traded company in human history. For the first time in history, you can go broke on paper. The paper isn't even yours. You buy and sell VOC shares on the exchange floor. You also trade futures, contracts to buy pepper and nutmeg at a fixed price before the ships even return from the East Indies. You live in a tall, narrow canal house. Land is expensive in Amsterdam, so buildings go up, not out. A clerk handles your correspondence. A broker executes your orders. The wealth is understated. The ledger is everything. Edge. You can short sell. You can buy options, instruments that won't exist anywhere else for centuries. Amsterdam just invented the derivatives market, and you're standing in it. Risk. It's 1637. At the peak of tulip mania, a single Semper Augustus bulb sold for 10,000 guilders, enough to buy a house on the canal. 6 weeks later, worth less than an onion. Speculators who mortgaged their homes to play the bubble lost everything. The first asset bubble in history. The market can make you a fortune on Monday and take your house by Friday. This is where trading stopped being about goods and started being about belief. Era 4, London, England. 1720. The Coffeehouse Trader. You're in Jonathan's Coffee House on Exchange Alley. This is where the London stock market actually lives right now. No formal exchange yet. Just this room, these tables, and these men. You trade shares of the South Sea Company, the East India Company, and government bonds. Your market data is a handwritten price list pinned to the wall, updated twice a day. Amsterdam built a proper stock exchange 80 years ago. London's financial capital is still a coffee shop, and the man who just sat down next to you may be about to give you the tip that makes you rich or the one that destroys you. This is the trading floor. It smells like coffee and pipe smoke and desperation. You live in a Georgian townhouse in the City of London. You lunch at the coffee house, dine at home, read price sheets by candlelight. Edge. Access. The right coffeehouse table gets you news from ship captains, government insiders, and foreign merchants before anyone else. In this market, information travels at the speed of gossip. Risk. The South Sea bubble is either building or about to burst, depending on exactly when you've landed. Thousands lose their life savings in 1720. Isaac Newton loses £20,000. The man who invented calculus got wrecked by market mania. You're holding the same shares. Your entire edge is about to be wiped out if you're holding South Sea shares. Era 5. New York, USA, 1920s. The ticker tape trader. The NYSE trading floor is full, loud, and electric. You trade stocks on margin. 10 cents buys you $1 of exposure. Your market data is a thin strip of paper printing prices in real time, running a few minutes behind the floor. You live in a Manhattan apartment. Good building, good address, lunch at Delmonico's, evenings at jazz clubs or the theater. The wealth is visible, the confidence is louder. Then comes October 1929. The market loses 89% of its value over the next 3 years. Not a dip, not a correction, 89%. 10-to-1 leverage works the other way with equal force. Fortunes built over years evaporate in days. Some traders don't recover. Some don't come back at all. Risk, leverage amplifies everything. In a bull market, everyone looks like a genius. In a crash, 10-to-1 margin doesn't halve your losses, it multiplies them. October 1929 is the definitive proof. Era 6, anywhere. 2026. The modern trader. The first thing you notice is that the trader is gone, not the person, the place. You trade from a laptop or a phone. You could be on a beach. Your broker is an app. Your data feed is instant. Your chart is the same chart every other trader on the planet is looking at. You have access to more information, more instruments, and more leverage than any trader in any century before you. Stocks, options, futures, forex, crypto, commodities, all from the same screen, all in the same afternoon. You're not competing with other traders. You're competing with machines that don't feel fear, don't feel greed, and have never once second-guessed a trade. Your edge isn't location. It isn't a coffeehouse table or a pit position. For the first time in history, your biggest enemy isn't the market. It's your own behavior. Edge, asymmetric access. A retail trader in 2024 has tools, data, and execution speed that Goldman Sachs couldn't buy in 1990. The barrier to entry is zero. The cost of a bad decision is equally immediate. Risk, infinite distraction, infinite noise. 24/7 markets with no closing bell. Every trader in history had a forced pause. The pit closed, the ships came in, the clay dried. You don't get that pause anymore unless you build it yourself. You have more power than any trader in history. And most people still lose, not because the tools failed them, because the psychology did. 6 errors, 6 crashes, 6 different ways to lose money on the same mistake. The tools got better, the markets got faster. The outcome didn't change, because the problem was never the market. It was always the person looking at it. The Babylonian lost to a king's decree. The Venetian lost to a storm. Newton lost to himself. You have better tools than any of them. So why does the failure rate look the same? That's not a rhetorical question. That's the question. Every trader who ever lived thought they were the exception. Most of them weren't.